What's up, guys? It's Jackson back again with another video. This is GNS Academy, and this is the fifth video of an educational series, uh, giving you an A to Z, beginning to end of how to trade, how we trade, and this should be helping you guys out a lot. Okay, the first video was talking about just basic entry level questions and like a quick history of trading and how it all came to be. Second video was talking about candlesticks like dojis, engulfings, very important. The third and fourth video we're talking about fair value gaps and inversion fair value gaps. Okay, this video is about liquidity. It says ICT because ICT stands for Inner Circle Trader. Look him up on YouTube. These concepts that I'm teaching you guys comes from him, just a shortened little condensed version. If you need to look up more information, go to his page, look it up. Okay. Um, these theories right here, this theory of liquidity is just as important and or equally to fair value gaps. Okay. So this is not something to just put on in the background, you know, like I said for the fair value gap video, make sure the kids are asleep. Make sure you can watch this without being interrupted. Grab your pen and paper, your water, use the restroom, all that good stuff. Let's go ahead and lock in. Quick background about who I am, what I've done. I'm a day trader, been day trader for 4 years. I finally, thankfully, found profitability and consistency. Been a profitable trader for a year and a half. I started with Apex. I've had Apex accounts. I have Top Step and Alpha Futures accounts. Right now, I have 6 accounts and have gotten multiple payouts. Okay. Uh, However, I'm more proud that I've been able to teach my good friend. He started in June of 2025. 4 months later, he was able to get his first prop firm funded account, and he was able to get his first payout. In December, it's December now, so 6 months later, he was able to get, now he has 5 funded accounts and has gotten, another payout. So very proud of him. That's what I'm mostly proud of. And what we want to do here at GNS is replicate that. So it's one thing that I could trade, but it's another thing I've been able to teach someone. And what we want to be able to do is go ahead and teach you the same stuff that he knows and that I know. Okay, so grab your pen and paper, give yourself a pat on the back because we're starting this and learning this information. Let's go ahead and lock in for a little bit. So key terms, right? Before we can continue, let's go ahead and just go over this information real quick. What we're going to be talking about and this whole presentation is going to be pretty much about is stop losses, take profit, swing highs, and swing lows. Words that I haven't used in other PowerPoints, or if I haven't gone into depth. Okay, so before we can learn about liquidity, we got to know what stop losses are and whatnot. So right off the bat, stop loss, or also people use it as SLs. This is the area or point where we exit our trade and where we suffer a loss. Okay. Take profit is the area or point where we exit our trade and we win the trade. Okay. So let's start here. This box zone right here is just a tool that we use on TradingView, the website that we use to analyze our charts. Okay. It gives us many tools like these arrows, right? But it also gives us a tool like this right here. Okay. It's just profit tool. So this line right here will be the entry. Okay, that's where I enter the trade. This candle right here, that line right there would be the entry. That's where I enter the trade. Okay, so when you see these pictures happening, no, that's my entry. That's the trade. Okay, in this case, I'm going for buys. We heard this term before in the previous PowerPoints, right? If I'm going for buys, that means I want the price go up. If I'm going for sells, if I'm going for buys, I want the candles to go up. If I'm going for sells, I want the candles to go down. I'm predicting that the candles will go down. And buys, I'm predicting the candles go up. To where? To when do I get out? When do I win? That'll be at the end of the zone. Look at the end zones here, okay? The end zones. The end zone that's green, if I'm going for buys, that'll be the take profit. That's the end zone, the area or point where we exit our trade and we win, make money. That would be the end zone. That would be the TP. Don't worry about the color. Don't worry about the inside of the zones. Worry about the end of them. These don't even have to be zones. They could just be lines. Draw a line across. If the candles go past that line, that is my stop loss. That's where I lose a trade. Okay. If I draw a line up here and the candles go across that line, the finish line, then that would be my take profit, and I stop and I get out the trade. Look over here. I'm going for sells. So where would my finish line be if I want to win? It should be lower because I want the candles to go lower. I'm going for sells. So my finish line, my end zone, the end of the zone would be right here. That's my TP. That's my take profit. Look above here. The end of the red zone, my stop would which the end of the red zone would be my stop loss right here. I could put a line here if I wanted to and put, if the candles go past that line, that's when I get out of the trade. That's when I lose. Okay, so that's why we have this arrow here, because at the end of this zone is my stop loss. Look at this arrow here. That's the entry where this white line is, or whatever color line that is. Okay, stop loss, take profit. Stop loss right here. Stop loss right here. Take profit over here. Take profit over here. Okay, we'll go over more of that right now. What else do we have? Swing highs and swing lows. Okay. A swing high is an area on the chart that looks like a peak or the high of a mountain. Let's stay there. Swing high, right? Look at this right here. A swing high, a swing high, a swing high. Why? Because that is like the peak of a mountain. If we're going up on an uptrend, which is words that we've used before, an uptrend has swing highs and swing lows. It's an uptrend. When it's going up and it makes a top part and it comes down, that top part would be a swing high. Okay, just like in the picture illustrated right here. Swing low, an area on the chart that looks like a valley or a low of a mountain. Swing low, swing low, swing low. What is this called? An uptrend, right? We learned that in the previous PowerPoints. This is an uptrend. What do we have here in the uptrend? Swing low, swing high, swing low, swing high, swing low, swing high. We have a low, high, low, high, low, high. What is this? A valley, a peak, a valley, a peak, a valley, a peak. Okay. Look at it like a roller coaster. These people up here, where are they? A swing high or a swing low? Look down here. Where would they be? A swing high or swing low? Up here, down there, up here, down there, right? Up here, they're at a swing high. Down here, they'll be at a swing low. This is a swing low. That's a swing low. That's a swing low. That's a swing low. These are swing lows. That's a swing high. That's a swing high. That's a swing high. That's a swing high. These are swing highs, okay? Swing lows, swing low, swing low, swing high, swing high, swing high. We're going to sear. You're going to hear me say this 100 times this PowerPoint presentation, okay? Swing high, swing high, swing low, swing high, okay? Look at this picture. What do you have here? Swing low, swing high, swing low, swing high. What do we have here? Swing low, because this is like a valley. Swing high, the top of the mountain. Swing low, and then swing high, and then we come down here. It's probably like a swing low around here. Okay, top of the mountain, valley, peak, valley, valley, peak, valley, peak, valley, peak. Swing high, swing low, swing high, swing low. Top of the mountain, valley of the mountain. Okay. Now let's put them together. What you'll notice in the market, the way we trade, the way any trader trades in the world, they put their stop losses, which will be the point that they lose their trade, the line, the end zone where they lose their trade. They put their stop losses at swing highs and swing lows. Okay, so now we're trying to put it together. Look at this picture. My entry is right there at that candle. I'm going for buys. I'm predicting that the candles are going to go higher, okay, to my TP. But where's my stop loss? At the swing, what is that? Swing low, okay? We have a swing low here, a swing high, a swing low, just like this right here, just like that, just like the low of the roller coaster. If this is a roller coaster, a mountain, this is a swing low, this is a valley, okay? I'm putting it right here at the swing low and it's going up, okay? I want the candles to go up. My stop loss is at the swing low. Take it on this picture. What am I doing here? I'm predicting that the candles are going to go down. I'm going for what? Sells, right? Entries right here on this candle. I'm predicting that the candles are going to go down, okay, to my TP. Where's my stop loss at? over here. Okay, what does that mean if the candles go up to my stop loss? I lose the trade. Where is my stop loss at? The swing high. Okay, all the terms that I'm teaching you right here could be seen in these two pictures alone right here. Stop loss, swing high, swing low, entry, entry, TP, TP. Okay, swing high, swing low, swing high, peak, valley, valley, peak. Okay, why are we putting them at swing highs or swing lows? Why are our stop losses at swing highs and swing lows? It's not just me. It's the way everyone's taught. It's the way everyone does it. Why? Because let's pretend that I'm going for buys and I'm predicting the candles to go up, but instead they come down past the swing low, right? It comes up and it drops down really fast. Engulfing candles, decision made to sell, and candles are going past the swing low. It hits my stop loss. I lose the trade, goes past a swing low. I was probably just wrong on my prediction that is going to go up and is going down. So we put it at swing lows to let us know that we were just wrong. Okay. If we put our stop losses anywhere else and then we lose the trade, we don't know if we could have been right. We just put it in the wrong spot. Stop loss placement is really important, and we put it at swing highs and swing lows because if the candles go there, most likely you were just wrong on the direction. Over here, enter right here for sells. I'm predicting that the candles are going to go down where my TP is. Okay. Now let's say the candles go up, bam, 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 engulfing, and they fly up, right? What does it do? Hits my stop loss. I lose, but it's also going above the swing high, which means the candles are probably just going to keep on going. Okay. So stop losses at swing highs and swing lows pretty much just tell us that not only we lose a trade, but we were probably wrong on the prediction, and we're all are going to be wrong on the prediction every once in a while. Our win rate is 80%, so that means we lose 20% of the time. Sometimes it's user error. Sometimes we're just wrong. Or sometimes we're too early. There's many reasons as to why we could lose. Just know 80% of the time we win and we were right on the direction. We put our stop losses at the swing highs or swing lows. Okay, so Stop loss. Stop loss is at the end zone where if the candles go, we lose the trade. Price hit my stop loss. Okay, the candles hit my stop loss. Stop loss is up here. That if the candles go up there, I lose a trade. On the contrary, I enter here and I'm going for buys. Where would be my end zone? Where would it be where I win the trade and I'm out? Well, it depends on where you draw it. Okay, it would be the end of this green zone. The end of this green zone. That's my TP. TP hit. We say that a lot in GNS. So TP hit. You'll hear that a lot. Swing highs and swing lows. The peak and valley. Okay. These are swing highs. Those are swing lows. Swing low, swing low, swing low. Swing high, swing high, swing high. However, put them together. What's over here at the swing low? Stop losses. Let's say we're going for buys. I'm putting my stop loss at the swing low. Let's say I'm going for at this swing high right here, and it comes down, and I'm going for sells. I put my stop loss at the swing high. Let's say we're right here at the swing low, and I'm going for buys. Okay, I want the candles to go up. Stop loss at the swing low. Let's say I'm right here, and I'm going for sells, and I want the candles to go down. Stop loss above the swing high. This one more time. Let's say I'm going for buys. I enter right here on this candle. Stop loss is at the swing low, and I'm going up for buys. If the candles decide to come down to my stop loss, it's going to the swing low, and it's probably going to continue to go down. Okay, so stop losses are at swing lows and swing highs. That's very important to know that stop losses are at swing lows and swing highs. Why is it important? Well, because that is where liquidity is. Okay, let's define liquidity. Areas where stop losses are located. Where are stop losses located? Swing highs, swing lows. Those are areas of liquidity. Okay. What do we mean by liquidity? Well, that is where money is at. Let's say we're using it in business terms, right? What's your net worth? Okay. Your net worth is just everything you own, maybe a house, businesses, whatever. How much investments do you have? Okay. Crypto, real estate, Vanguard, S&P 500, investments. How much liquid do you have? How much liquid money do you have? That is money that you have in your bank account, in your wallet, in your safe, that you could deploy right now. It's not money that, oh, if I sell this watch, if I sell this house, then I'll have, if I sell all my real estate, I'll have $1 million. You don't have $1 million liquid though. How much do you have liquid right now that if you needed to give some money or invest some money right now, liquid? So if you're getting into a business, they're going to ask you, well, how much liquid do you have? Okay, I have this much money liquid. Liquid is cash. Liquid is money. Okay, liquidity means money. So that's the definition of liquidity. Where is the money at? Where is the liquidity at in the market, in the charts? Swing highs and swing lows. Why? Because that's where stop losses are. That means that if people lose, then they lost their money, and that money goes into the pool and pays the winners out. So that means essentially where the stop losses are is where the money is, because we need them to lose, and then that's our money. So we call it, that's where the money is. It's where stop losses are. Is where stop losses are when people get taken out and they lose the trade. That money gets taken from their account. Now that money is liquid and is given to us. So liquidity is where the stop losses are. Where are the stop losses at? Swing highs and swing lows. Okay. That money that when people get taken out of their trade is given to the people who win. So the market is actively looking for stop losses to take them out so that the market could have a lot of liquidity and money and cold hard cash to pay people out when they win the trade, when we win our trade. Essentially, we need people to lose. We need the market to take people out so that we can get paid. There's no other way we can get paid unless people lose. It's a zero sum game. When I'm in a trade, I'm going against someone else. I'm going for buys. I need someone to go for sells. When they lose, I win. If I lose, then they win. It's a battle going on in every single trade that you're in. Okay. What we want to do is use the knowledge of where the stop losses are to our advantage. So when people get taken out of their trade, then and they lose, then we could enter and whatnot, which we'll get into right now. Before we move on, just know what liquidity means. Liquidity is money. Okay. Where is the money at on the market? Okay. It is at where people's stop losses are. It's not where their take profit is, because if it's where their take profit is, then they're getting money from the market. They're sucking money out of the market. They're just going into their account. So that's the TP is not what we care about. We care about their stop losses. So when it hits when it hits their stop loss, they lose the money, and now that money is ours. It's in the market. It's in the bank. It's in the pool of losers. And then when we win, we take money from that pool. When they lose, we win. So where is the money? Where they lose. If they lose, we win. So we need them to lose. So where is the money at? Their stop losses. Where is the stop losses at? Swing highs and swing lows. So where is liquidity? Where is the money? Found at swing highs and swing lows on all time frames. 1 minute, 5 minute, 1 day, 1 week, 1 month. The swing highs and swing lows on the chart. This is why this chart doesn't have a time frame on it. It's just where it is at. Okay. Not only at swing highs and swing lows, but the little highs and lows in between the peaks and the values, the little parts. Also found at double tops and double bottoms, which we'll talk about right now too. But let's just look at this simple picture, right? What do we have here? We have an uptrend, right? We could just do a bunch of definitions here. What do we have? An uptrend, right? Okay. What else do we have? Swing high, swing low, swing high, swing low, right? We have some little highs here and little lows here. Okay. What's going on at the swing highs? What's going on at the swing lows? Stop losses. Just like the picture I showed you guys. Swing low, swing high. What's there? Stop losses. Stop losses. It's not just how I trade, it's how everybody in the world trades. Especially retail traders. Okay. So what do we have here? A swing high, a swing low. What is over here? Stop losses, stop losses. What does the market do? Up, down, up. If a stop loss is there, that means that if the candles go to my stop loss, then I am out of the trade and I lose. So what does the market do? Bam, go higher than my stop loss, takes me out of the trade, and then what would it do? Come down. What's over here at a swing low? Stop losses. Okay, money, liquidity. There's just liquidity resting right here. People's stop losses are right here. Oh yeah, I'm going for buys. I'm going to the moon. Bang, the market comes down. Bam, triggers their stop loss. Their stop loss is right here. If the market goes any lower than if the candles go any lower than my stop loss right here, then I'm out of the trade and I lose. What does the market do? Okay, boom, takes them out. That's where the money is at, because people's when people lose, they lose money. So we need them to lose their money so that we can win. So where is that money at? How do we make them lose? Well, let's go towards the stop losses. Where's the stop losses at? Swing highs and swing lows. That's the theory of liquidity. What does it do? Bang, takes it out, flies up. What do we have here? A stop loss. What do I have people here? Oh yeah, I'm selling forever. It's gonna go forever. I'm gonna sell. Stop loss above here. I'm entering here for sells. Market comes down. What does it do? Bam, takes them out too. The market is actively sweeping and taking liquidity, hunting for liquidity. It has to. It has to take people out and make them lose so that it could pay people out. How would the market and how would you make money if everybody won? How would you get paid? You literally need people to lose. You need people to not be good at trading. You need people to have psychology issues. You need people to have a bad strategy. You need people to not know how to trade or not be good at it. And you need them to lose and put a lot of money in there so that we could get paid, which is why 98% of the traders that trade lose. They're inconsistent, they're unprofitable. Here in GNS, we're part of that 2 to 1%. Only 1% of people pass accounts, and only, 0.5% get a payout, and only like 0.1% get multiple payouts. Okay? How are we getting paid? By the 98% of people that lose. That's just how the market goes. The market is actively trying to take people out and make them lose so that we can request our payouts and request it. If everybody won, then everybody would be requesting a payout. And if nobody lost, then how are you getting that money? Everyone is making money. It can't even work. The market has to take people out, and the people have to lose. Nature of the beast. So now, why is it important? Which I've been explaining already since the beginning. Liquidity is needed for people to get paid. We need people to lose so the winners can win. Okay, trading is a zero-sum game. Um, this means that for every winner in day trading, there is a corresponding loser. If we know where the liquidity, the money, the stop losses are at in the market, we can use it as a target because we know the candles, the market wants to go towards it, or we could wait for liquidity and people's stop losses to get hit and the market go the other way, and we can go with it. We can go both ways. We can go towards liquidity, or we can wait for it to get taken and go the other way. Look at this picture here. What do we have here? A swing high, swing low. What does this look like first? Does this look like an uptrend or downtrend? Okay, wrong. It looks like consolidation, or maybe you knew that. Okay, why? Because it's not going up or down. Okay, so what does the market do? Downtrends, uptrends, consolidation. What do we have here? Consolidation. What do we have here? A swing high, swing low. Swing high, swing low. Okay, what do we have here? A swing high. What is that swing highs and swing lows? This whole PowerPoint. Stop losses. Okay, so we have a stop. People are going for sells here. They want the candles to go down. Stop loss above the swing high. Let's go down. What do we have here? The candles go right here. It starts going up, going for buys. They think it's going to go to the moon. Stop loss at the swing low. What does the candle do? Bang. The candle's doing, the chart doing, going up. Bam. The stop loss means that if the candles go to my end zone of the stop loss, or my line of the stop loss, if the candles go to there, then I lose the trade and I lose money. So where are the stop losses at? In this area, this liquidity pool. Stop losses here, stop losses there. What does the market do on purpose? Take them out. Bang. Millions of dollars, millions of people lose. millions of dollars available, liquid, and then bang, the market flies up. Okay, what does it do? Seek liquidity again. Millions of dollars, hundreds of millions of dollars of people, because they put their stop losses here around this area. What does the market do? Bang, take them out. That's where the money is. That's where the liquid is. That's where the liquidity is. There's a bunch of money here, not TPs or nothing, but stop losses. Because if we can get them to lose, now we can get money. Now, what does the market do? It acts on that. It goes, takes them out on purpose, and then it goes the other way. We could use it as a magnet so we can go towards it. We want to go for buys. Let's go towards where liquidity is. Stop loss at the swing low. Let's go for buys, and we can go target liquidity, or we can wait for liquidity to be taken because we know liquidity is here. We know where the stop losses are. We wait for the market to take the liquidity or take people out of their trades. And then when we see dojis and engulfing, decision made, let's go. Let's go for sells and let's put our stop loss above. So we're still putting our stop losses above swing highs and swing lows. However, we want to wait for liquidity to be taken. We want to wait for everyone else to lose and then we get in. We don't want to get taken out. Okay. So what do we look for? I guess I can put myself right there. That's fine. Okay. What do we look for? So another image, right? What we want to do is identify areas of liquidity as swing highs and swing lows. Okay, the 3 time frames we use is a 4 hour, 15-minute, and then 1 minute, 2 minute, 3 minute, whatever. But which we'll get into on the entry model. We are looking to see if price is showing signs of reversal at liquidity areas. Okay, swing highs and swing lows. What would signs of reversal look like? We go to a swing high, doji, engulfing, making decision. Okay. We're tying day 1 stuff with day 5 stuff. Doji is an engulfing. Doji means indecision, engulfing means decision. So if we are over here at this, what is this, right? This PowerPoint, we're learning about swing highs and swing lows. If this is a swing high, what do we have here at swing highs and swing lows? Stop losses, okay? Make sure you're paying attention, write this stuff down. It's super important. What do we have here? A swing high. What are at swing highs? Stop losses. What are stop losses? Liquidity. What does the market want to do? Seek liquidity. Bang. It goes up, takes it out, makes people lose. But what are we going to see here? Doji, bearish engulfing. Bang. Decision made. That's how we know liquidity was swept. And we were going to enter for sales here and put our stop losses above that swing high. Hopefully we don't get taken out, right? But we already should hope that we're not going to get taken out because we took some liquidity and took people out of their trades, went to the swing high, hit their stop losses. Okay. What would be liquidity at, now there's different terms. What would be liquidity at the swing high? We call that buy side liquidity, right? Why buy side? Because, I don't know the term, but if you could think of it this way, we have a swing high. So we would think of it as like the buy side, the top side, the high side, the buy side. When we think buys, we think going up, right? Whenever we think buys, I want candles to go up, buys, bullish. Okay. So buy side liquidity would be liquidity above at a swing high. Sell side liquidity would be, think of, I'm going for sales. I want to go for sales. I'm in a trade for sales. I want the candles to go down. I want the candles to go on a downtrend. Bearish, swing low, sell side liquidity. That's on the sell side, the bottom side, the bearish side, the downside, the sell side liquidity. Okay, so at a swing low, we have sell side liquidity, SSL. On a swing high, we have buy side liquidity, BSL. Okay, liquidity is liquidity. You could just say, oh, it looks like you're going to take this liquidity here. You could say it's going to take this liquidity here. But if you want to get really technical, the words that we do use is BSL and SSL. Buy side liquidity, sell side liquidity. Buy side liquidity is at a swing high, okay, on above. Sell side liquidity is at a swing low, below sell side. Okay, usually price will go ahead and seek SSL or BSL with a doji candle or with a wick, with a couple wicks, and then it'll reverse the other way. Okay, so let's say we take out BSL, buy side liquidity, at a swing high where stop losses are. This looks like dojis, bearish engulfing for sells, it goes down. Why is it doing that? Because many people had their stop losses here. It took them, let's say there's millions of dollars of stop losses here across the whole world. The market comes, dojis, takes them out. They exit the trade. They lose their trade. That market is that money is put into the market as liquidity, and then or they are liquidity in a sense. And then now we enter for sells, GNS, and then we win, but we're getting paid from the losers. It's pretty toxic. That's how the nature of the beast is. So, okay. This is a quick little part here, but liquidity sweep is when buy side liquidity or sell side liquidity is taken and then the price reverses. Okay, so let's say we hit sell side liquidity and it makes dojis and then engulfings a bullish engulfing for buys. So it pretty much uses it as a reversal. It takes out the sell side liquidity, it takes out the liquidity, hits the stop losses at a swing low, and then it goes up. Okay, that's a liquidity sweep. It sweeps it. Whoosh. Or on the top side too, it can just come up and go up and then sweep it whoosh, and go down. Which I think we had like on this right here. This would be a liquidity sweep. Why? It swept it really quick and then came down. And then it came to target this. What do we have here? Liquidity sweep. It came down, bang. Took out the stop losses at the swing low and went up. Okay, it swept it. And then up here at a swing high, right? Old high. Swing high. Stop losses. Buy side liquidity. What did the market do? Seek the buy side liquidity, sweep it, came down. Okay. Liquidity, that's a liquidity sweep. Okay, liquidity run is where price just goes through it. It's still targeting it, but instead of sweeping it, it just runs through it. Instead of doji and engulfing, it's just engulfing through it. Okay, look what happened here. Look how SSL was swept and BSL was ran. Okay, we're using some terms now. Shouldn't get too crazy, just try to understand, right? Swing high, swing low, swing high, swing low, swing high. Stop losses, stop losses, stop losses, stop losses, stop losses. What kind of stop losses are here? Sell side. What kind of stop losses are here? Buy side. Buy side liquidity. Sell side liquidity. What's down here? Sell side liquidity also, right? But let's, in this case, look what we're doing. We're having a swing low. We have stop losses right here. Entering for buys, they're going up. What is going on here? Drops. Swing high. What are at swing highs? Stop losses. Stop losses are liquidity. What liquidity is this? Buy side liquidity. We come down, the market comes down. What does it do? Targets the swing low, targets the stop losses, targets the sell side liquidity. But what is it doing? Is it sweeping it or running it? It sweeps it. Now what is it doing here? Swing high, stop losses, liquidity, buy side liquidity. The market is seeking it all the time. What does it do? Bang. It runs through it. It doesn't sweep it, it just charges through it with engulfings. Okay. We don't use, liquidity sweep and liquidity run like the term so much. We just say that it's seeking liquidity, but there's a difference in terms of how it looks. But just know like liquidity is here, sell side liquidity is here, buy side liquidity is here, and it's trying to take them out. It's trying to go for them all the time. Okay. It's the difference between a freaking hook shot and a hook and a jab. This would be like a hook. This would be a jab straight through or something. You know, the same thing is you're trying to freaking punch someone and knock them out. Same thing here is a sweep right here and a run right here. There's liquidity being taken and liquidity being taken still. Okay, so let's recap it. Let's look at this picture. Swing high, swing low, swing high, swing low, swing high, swing low, like a roller coaster, a peak, valley, like a mountain, peak, valley, peak, valley, peak, and valley. What do we have at swing highs and swing lows? Stop losses. It says right here, stop losses, stop losses. Okay, stop loss, stop loss. What are the stop losses at the swing lows? Sell side liquidity. What is the stop losses at the swing highs? Buy side liquidity. Okay. What is this right here? Consolidation. Just an extra little pointer. Let's read it here. Oh man, sorry, I'm in the way. Look at it here real quick. Swing high, swing low, swing high, swing low, swing high, swing low. Stop losses here, stop losses here, stop losses here, stop losses here, stop losses here. Roller coaster, swing high, roller coaster, swing low. Peaks, valleys, peaks, valleys, peaks, valleys. Stop losses above here, sorry, and then stop losses down here. It says it right here. Retail stop losses are right here at the swing lows. Retail stop losses are up here at the swing highs, okay? When the stop losses are above, they're called buy side liquidity. When there's stop losses below at swing lows and swing lows, stop losses below, sell side liquidity. Okay, liquidity is very important in the market. Extremely important, right? Fair value gaps are areas where price may go because people think, okay, that's fair. Milk was $1, tomorrow is at $4. I'm gonna wait for it to get to $2. That's fair value. That's the best value I'm gonna get. Bitcoin was at 100K. Now it dropped down to 80K. I'm gonna wait for it to get to 95K and I'll sell my Bitcoin because that's probably the best value I'm gonna get to sell it again. Okay. Fair value act as magnets. That's why it's important to know where they are so that we can use them to our advantage. The market runs in two ways. The market works in two ways. It goes to fair value on any chart, whether it's oil, gold, silver, Bitcoin, NASDAQ. It is looking for a fair value and it's also seeking liquidity. Liquidity acts as a magnet as well. Since we know that there are areas of liquidity like buy side and sell side liquidity, we know where those stop losses are. We know that the market needs to take people out, make people lose so that we could win. Where are they going to lose? At the stop at swing highs and swing lows. So we know that that the market is triggering their stop losses, making them lose so that we can win. That is how the market goes. Okay. Um, it says right here, liquidity is needed for the market to even exist. If there aren't people participating in a market, putting stop losses, entering the market, and there's no liquidity and there's nobody even trading, then we can't even win. If there's nobody participating, there's not enough liquidity, and when people win, they can't get paid. So not only do we need a lot of people to do we need people to lose, but we need a lot of people. Thankfully, the stock market, futures market, forex market has billions of dollars, billions of liquidity, millions of people trading around the whole world, and millions of people losing. Okay, so we need these people to put in money and lose so that we can get paid. The market creates liquidity just to take people out sometimes. It'll be like, okay, I'm gonna make a swing low here, I'm gonna make a swing low here, I'll make a swing low here, and people are gonna enter for buys, put their stop losses here. Let's say over here. The market will generate it on purpose. The charts will generate it on purpose. Okay, I'm gonna make a swing low here, come back here, make another swing low here, come back and make another swing low here. People are entering their buys, putting their stop losses, sell side liquidity. The market comes back, bang. Wicks makes a doji, flies the other way. Okay. That is the nature of the beast. The market does two things: seeks fair value and it takes liquidity. Seeking liquidity, seeking fair value. So that is the theory of liquidity. Okay. Now, watch this video a couple times. I'm going to put correlated videos along with this to help it make more sense. We're getting close to the end. Okay. So stick with us. Give yourself a pat on the back if you made it this far. Okay. Liquidity and fair value gaps are everything in the way that we trade. It's all going to start coming together when we talk about the entries in the AP model, the way we make money, the model that we trade every morning. It consists of fair value gaps and it consists of liquidity. So before we can get into how we make money, the bread and butter, the money maker, you got to know these terms. Okay. The best way you're going to understand it and make it make sense is showing up in the mornings and watching us do it in real time. I'm going to make live sessions and record them. I'm going to be recording and going over trade recaps, trades that we took, why we took them. It's going to be because liquidity was taken. It's going to be because a fair value gap was inversed, things like that. Terms that you might know, you wrote down, you studied, watched the videos on, and we're going to see it in real time. Okay. Um, give yourself a pat on the back if you made it this far. This is the beginning of a very beautiful journey for you guys. Um, and you know, don't rush the process. Watch these videos, understand it, grasp it, is going to make more sense the more we practice it. These next couple videos are going to start bringing things together, and then we're going to start really putting in some good work. So good job, GNS. We'll see you guys later.